Hi, I am Dimitri from Silver & Young Private Wealth, and I'd like to welcome you to a new episode of Behind the Wealth podcast. We explore, investigate, and analyze topics of wealth creation. I'd like to welcome you to a new episode Behind the Wealth. Also, please note that this is a general advice and is not an advice tailored for your needs. So if you have more questions, please give a call or email your accountant or your financial planner or us if you wish so. I would like today, in today's subject, to talk about biases. And the reason I like to talk about biases is because when we approach investments, sometimes, actually many times, we are biased to certain investments more than others. So I just want to make a little bit overview what is a bias. A bias is really a preconception, and we have a predetermined opinion about something. And sometimes it is positive or negative. We like some more than we're supposed to like it, or we dislike something more than we're supposed to like it, and not for particular reasons. And that's called biases. So one of the most characteristic biases for when we go and do certain investments, it's the blind spot bias. So we're failing to recognize that we don't understand everything and we don't have a full picture of the investment we want to do. And but we underscore that and we undervalue that cognitive bias that we have for ourselves. We can easily recognize this bias to other people, but not to us. We just give a bit more high marks that we understand than we give to other people about a particular investment. Another bias is a conservative's bias. A classic example of that is for when the science discovered that Earth is not flat and it is round or a sphere. People didn't want to believe of that because out of conservatism, they always believe that the Earth is flat. So a lot of times we have this view for investments as a bias, and it could be positive and negative as well. Choice supportive bias. When you choose an investment that it feels good because you are familiar with that investment compared to another investment because you're not that familiar and you don't really feel good about that investment, you just disregard it. Of course, it's very important for us to understand any investment we do. So I'm not talking about that particular point. Of course, we need to understand every investment we do. It's just a bit of bias. For example, some people say, oh, I will never touch property or I will never touch shares. But historically and by fact, the two asset class performed quite well. And there is no really one superior to other, just the one it performs better in certain circumstances than other. Another very bias, it is the ostrich effect bias. We ignore and we underscore negative factors. Say we go to a business and the business is turning beautiful turnover and we want to buy the business, but there are some negative factors, say, for example, the efficiency of the current owner, the change in the demographics of the location, a key staff member, that it is very important to the performance of that business. But we still ignore that or underscore that effect could have to the investment because we don't want to deal with that at the moment. And so we give less value to that than other factors for us to decide if we go ahead with that business decision. The other one is the overconfidence bias. The overconfidence bias, it is a bias that affects our ability and judgment. And this is also very common with financial planners that advise other people. Say, for example, I'm very confident in property. I tended to advise more in property, or I'm very confident in shares. I intend to advise more in shares. But in reality, we should recognize this overconfidence that, yes, I know about shares, but do I know everything about that particular share? So this overconfidence that I supposed to know in that particular instant, maybe I don't know enough for that particular share to advise my client or someone regarding that particular investment in this share. So we've done 2 or 3 property investments, and the 2 or 3 property investments done very well. And we feel very confident that we'll be fine. My thought will be good. But the characteristics of these property investments are different than the other 3 before that. So this overconfident bias we have, it tends to not pay attention to details one by one, because we are overconfident that we understand what is all about it. Of course, stereotype, this is very common that we usually do for people, but this applies to investments and to areas of wealth creation and employment. I mean, there are some professions or some trades that had a different stereotype than others. But believe me, as an accountant, I've seen a lot of different tradespeople that made a lot more money than professional people. A lot of, for example, you could be a plumber. I just use as a generic example. You can be a plumber and you really be able to make a lot of money if you have the entrepreneurial skills and the entrepreneurial mind. You don't need to be as such entrepreneurial and just deal with the hospitality and open business and close business. But really, a carpenter can be a very entrepreneurial and do a very good financially by having these abilities to be more taking a bit more risk, but the calculated risk and managed well, which is the fundamental parts of entrepreneurs, and go ahead with his life financially. Confirmation bias. We tend really to attract it to investments that we like, and then we go and sit with a planner or with an advisor or with a group of people that we respect their opinions, and they bring exactly the same conversation. Say, for example, we love property, and then we go to a group of property advisors which is the best areas to buy and what properties you buy. And suddenly we get out of these seminars and we feel totally convinced this is the only thing we can make money and we increase our wealth. Because what it happens here is the confirmation bias. Already have a bias that I love property. And then I go and I sit in a barbecue or with an advisor that he also, she loves property. And then suddenly it gives gratification to my opinion. And I said, I'm 100% right. You see, Dimitri also agrees with me. And I've seen this a lot of times with clients. The couple comes and one is property biased and one is share investment bias. And it doesn't matter what I say, everyone takes that as the confirmation of their opinion and discounts the other one. So we need to bring this together. And this is the job, of course, of the advisor, to make a more valid and more smart decision for the best interest of the couple collectively. So why the biases are so important for us to be considered? The reason for that is because a lot of decisions that we make for financial planning and for wealth creation is affected by our personal biases. For example, a person who comes from a family that never invested and never did anything with holding a share portfolio and only they did property, they're already biased against the share portfolio investment compared to property. Another, on the other side, a person who only thinks that property is the only way of wealth creation, uh, it, it just ignores or discounts that the share portfolio or a share portfolio which is properly managed and tailored to the risk tolerance of that person, of that couple, can work very, very effective for wealth creation in the long run. So the people who really create wealth have the ability to understand the biases. So when they go, and I've seen that, I had a client who came to me once and he said, look, I love property. Do you understand shares? I said, yes, I do understand shares. Okay, I want to talk about shares. And I was really triggered by this opening comment because I was expecting, I love property, you love property, I came to you because you love property and I love property. But this person was one step ahead of me and he said, I love property, I understand property, I know already about property. You understand shares, I want to talk about shares. The majority of the people, they want you to confirm what they really want to do and just need a bit of push for them to go to the next level and ignore all the other peripheral opportunities they may have by investing in different areas. And this is the problem when we are biased. Another issue is when we buy a business. Sometimes we fell in love with the business. We fell in love with the cash flow, the net profit, the potential that in 3, 4, 5 years, we're going to do this and this and this and that. And we undermine, we don't have really put under microscope the negative parts of that business. And then we become overconfident that our judgment, it is correct. And we see this when people coming to our office and they want to buy, say, usually it is coffee shops and delicatessen shops or secondhand shop. It just came to my mind now. And the people are really very positive about going to that business. And the question we always ask, what is the opportunity cost for you to leave your current employment that you earn XYZ dollars to go to that business? And what is the potential for that business to grow in the 2, 3, 5 years time? And we don't, of course, say do this or do that because it's up to the person to do it. But our job is to highlight all the things that they don't want to address and they don't want to consider in a more meaningful way and in a more structural way to say, okay, I need to consider that. I need to consider my lease. My lease is 1 year only. Then after a year, what's happened? I need to have a 3x3 or 5x2 or 2x5, whatever. So we need to consider that. And that's the value of covering up your biases, because that person has an overconfidence bias that he understands cash flow, he understands that business, but he forgets the other ones. That's why when we go and we buy a property, we send the contract to a solicitor. Although it's a standard contract, we still send it to the solicitor because it could be one line fine printed that makes all difference to go ahead or not to go ahead when you go, for example, to buy property through auction. There is no grace period if you change your mind. That's it. You paid your money, you're locked in. There's no the 10 days or 14 days to change your mind later on. And a lot of people, they don't know sometimes because they fail to send this contract to a solicitor and pay whatever it is, $300-400 to review that contract before they go to auction. And this is part of the very successful people. That is one of the boxes they tick every time they do any decision. And what it does, is stop them do serious mistakes in the future for them to achieve what they want to achieve, creation of wealth. So I had the comment that the concepts that I bring to the podcast and to my YouTubes sometimes become too long, from a very valuable staff member, and appreciated that. And a friend of mine, actually, who is also my client, George. And so I tried to make it a little bit shorter and more precise to the point of today's subject of the podcast. I hope you enjoy the podcast. And if you have any questions, please call our office or email me at pw@silveryoung.com.au. P as private, W as wealth, at Silver Young, silver as the metal, young as the youth.com.au. Till next time, have a good day. I hope you have enjoyed our recent episode Behind the Wealth, provided to you by Dimitri from Silver & Young Private Wealth. If you have any questions regarding our recent episode, please email us on pw, P for Peter, W for word, at silveryoung.com.au. Until next time, have a good day and enjoy life.